the primary source of growth and the primary source of both revenue and profitability growth at SoFi by leaps and bounds is the personal lending side of the business. And so that's obviously relevant. When you look at that business, I mean, they originated 13.8 billion last year. I have them originating around 14.25 billion this year. In my model, if you look at the principal balance on balance sheet, they have 14.3 billion, and they have those marked at a total carrying value of 15.06 billion.
So that's how they value. You say that's what it's marked at. And these are unsecured personal loans.
These are unsecured personal loans. If you took a step back, I think the point that you're kind of starting to move towards is the topic of making the fair value election, fair value accounting. SoFi has their personal loan portfolio as of the end of the first quarter marked at 104.24% of unpaid principal balance. So effectively, they have a $608 million cumulative fair value adjustment that's based on using the fair value election and then running a DCF model to value the loans at fair value.
How should one value a personal loan book? Ultimately, if you're going to value something, you want to know what the cash flow stream of those assets are. And that cash flow stream is going to be the interest income, or they call it the coupon, less the cost of servicing, should be small, minus expected defaults. That gives you the free cash flow. And then you discount those cash flows for each period in time in the future by an appropriate discount rate. Is that the right way to think about this?
That's a very good way to think about it. Maybe what's helpful is to take a little bit of a step back. When a bank or financial institution originates a loan, from an accounting perspective, they have two primary choices that they would make when they account for the loan. The first one would be to account for the loan at amortized cost. And if you did that, what you would do is you'd effectively take a $100 loan, put it on your balance sheet at 100, and you would then take an allowance for loan losses to cover the lifetime losses. There's some very slight nuances to that, but in this situation, if you took a company like a lending club, that would probably be somewhere between 7 and 8% upfront. So effectively, you'd originate a $100 loan and take 7 to 8% day one provision for loan losses, and you'd effectively have the loan marked at, call it 92 to 93. On the other hand, the second choice would be fair value, to elect the fair value option. And what you would do there is similar to what you were saying, is you would effectively run a discounted cash flow analysis on the loan and the portfolio of loans you're originating. And you would effectively NPV that based on your projections for the lifetime cash flows, such as duration, credit, timing, et cetera. And you'd apply a discount rate to get to a loan value. The premise of fair value, or the intent of fair value, is to effectively mark the loans at the value at which they should trade or they should transact in the market in an arm's length transaction. So when you look through that analysis, that is the goal of fair value, is to effectively put a market value on the loans. If you look at SoFi's case, the current portfolio is marked at 104.25 or 104.24.
That means 4.25% above the principal balance.
That's right.
They originated a loan, and they're saying that loan is worth more than the amount they disperse to the end customer. How does that happen?
And I would make one nuance point there. If you look at the portfolio that is currently on the balance sheet, that's a seasoned portfolio. So it's already realized some of its cash flows. We don't know the exact seasoning, but my estimate is that you'll probably have 6 to 8 months of seasoning on that one portfolio. Could be a little more, could be a little less. So you've already realized some of the cash flows. So the newer loans that they're originating that should have higher coupons, should be relatively better credit underwriting, because they've made some changes to the underwriting model for the last few years. Probably, based on my estimates, could be marked as high as 107 or 108, could even be higher in some cases. So when you look at the loans, the difference between fair value and amortized cost, which is the way that most financial institutions account for their loans, could be that same $100 loan would be, could take an example, would be a company like a lending club, where most of the loans that they hold for investment they use amortized costs. Their loans would probably be marked at 92 or 93 day one versus a $100 loan, whereas SoFi, based on my estimates, would probably be marked at 107. So you could easily have a 14 or 15% difference day one.
So under the fair value approach, which SoFi takes, and most financial institutions and peers of SoFi do not, so that creates some complexity here. They originate a loan. That means they make a loan to a borrower. Let's say it's a $20,000 loan. And then on day one, they say, hey, that $20,000 loan is actually worth 4% more or 8% more on their balance sheet.
That's right. That additional value would be recognized as revenue immediately. Whereas using the other methodology, or amortized cost, you'd recognize an expense day one. The important thing to say is, it's two different things. The lifetime economics, or the lifetime accounting for the loan, from a profitability perspective, will be the same over the life of the loan, no matter which accounting methodology you use. The difference, though, can be wildly material in the sense that you're effectively pulling forward your future earnings when you're using fair value. And then we can debate the accuracy or how justifiable the marks are. But if you take my estimates, and something I've published on many times in the past, and you took SoFi's portfolio and then you removed there's, as of the first quarter, 856 million of accumulated fair value, and then you apply the CECL estimate that's roughly in line with peers and similar assets, my tangible book value per share number would go from 387 down to $1.88.